Are you a non-resident and looking to see if you can get a mortgage in the UAE? So I'm here with Victoria from SPF Private Clients, who's going to have a chat about some mortgage regulations from the UK, or if you're a local resident here. Can somebody in England or a non-resident get a mortgage here in the UAE?
Yes, you
Yeah.
can get a mortgage.
Mhm.
There are a few banks that will mortgage
Yeah.
depending on the client's situation. But yes, it's possible.
Okay, and what sort of documents would they need to be able to get that in place?
So if we're keeping it very straightforward, there are banks that take a low document approach.
Uh-huh.
So what that means is that they just need to see an income coming in, but it's underwritten based on the client's savings.
Can it be self-employed, or does it have to be from their bank, from their employer, or what sort of
Both.
documents?
So if they're employed, I mean, it's pretty simple, straightforward, because they receive money every single month.
Mm-hmm.
If they're self-employed, all we need to see is an income coming in. There is no minimum income.
Okay. And then for property, because I know here, if you're looking to invest here for under 5 million, you put a 20% deposit down, and then over 5 million, you put a 30% deposit down. Is that
Yeah.
the same for a non-residential person?
So no, they'd need to put in a bit more. So
Okay.
they'd have to put in a 40% deposit.
A 40, okay.
40, yeah. So some banks will be quite a bit more lenient and they might allow 35%, but
Yeah.
the standard is 40%, I would
Okay.
say.
And what are the sort of rates you'll be playing with?
Good question. Anything between 4.99 up to about 5.99 currently.
So so if they're buying somewhere for like, let's say 2 million dirhams so they can get their golden visa,
Yes. Yeah.
they would have to put like 40% down, so like 900,000 dirhams
Correct.
or so, whichever
Yeah.
it is. Yeah. And then what are the fees? So you've got your DLD fee and the agency fee.
Yes.
Are there any bank fees that might be different, as in if you're a resident or a non-resident, to invest in UAE?
Yes. Yeah, so usually if you're non-resident, the banks charge a slightly higher, what's called a processing fee.
Okay.
So instead of it being 0 or 0.5, it can be 1%. It's usually 1% loan amount.
Okay, cool. And on the borrowing rates, the same as if you're a resident or a non-resident, like the percentage?
No.
Okay.
So if you're a resident, you could get as low as 3.75%.
Mm-hmm.
They range between 3.75 up to about 4.25 roughly, depending on whether you do salary transfer or non-salary transfer. But for non-resident, it is a bit higher because they don't live here. It's a slightly higher risk for the banks.
And obviously, like being here, you can become a resident quite easily.
Yeah.
Yeah. Could they just come over for like 6 weeks, let's say, or however long they need to get the residency in place, and then become a resident and get the resident fees and percentages?
This is a good question because we get this question asked quite often because people say to us, I have a golden visa, so
Yeah.
I'm a resident.
Mhm.
But from a bank's point of view, the way that they underwrite is based on where is your income being derived.
Okay.
So in order to qualify for resident interest rates, we'd need to see the money derived in dirhams.
Okay.
So if,
Cool.
for example, your money's being derived in pounds or euros or dollars, then usually the bank will then say, we're going to apply the non-resident criteria. Therefore,
Yeah.
the interest rate's higher, the deposit's higher.
Got you. Got you. Yeah. There's no little loophole
There's
for
no little- to be able to qualify to have a 20% deposit, 80% mortgage, and for the lower rates, or a 70% mortgage, 30% down payment, you'd need to be really employed or self-employed here for at least 2 years.
For at least 2 years.
At
Okay.
least 2 years, yeah.
So you can open like a structure here and employ yourself, invest your money into your company, your shell company as such, and then invest that. No.
See,
Was that
again,
bit?
this is a really good question because a lot of people do this. They open let's just say you have a company in the UK and then you open a shell company, an entity here, and you're paying yourself. But the big, I suppose, mistake is that as soon as you're on that trade license, the bank sees you as self-employed.
Okay.
So therefore, in order to qualify for the lower rates, for the lower deposit, we then need 2 years at least audited accounts.
Okay.
If you don't have that, so there's I suppose, like a policy, a criteria that some banks do, which is a low document policy. So this means if you haven't got the 2 years accounts and your company's been open and trading for at least 6 months,
Okay.
you can get a mortgage based on low document policy. because the banks just look at the business bank statements for your company.
Okay.
If you're 100% owner, they can also look at personal bank statements as well.
And then you would be able to fit into the less deposits.
No.
No. Okay. No. So you wouldn't fit into that.
No. So you wouldn't fit into that because you're a higher risk to the bank. You've only
Okay.
been self-employed 6 months. There isn't that track record there.
Uh-huh.
But so you will need a 40% deposit
Still okay. Yeah.
still,
Yeah.
but the interest rate will be slightly lower in comparison to the non-resident. So it will be around 4.7% up to about 5.25%.
And would setting up the company and doing it that way work or not really? Like,
I would
does it just
say
cost too much to do that for the little percentage you're saving?
it really depends on the client's situation. Like,
Hmm.
what are their plans? Are their plans just to be able to get a mortgage? Are they going to eventually move the business over here? So, any client that we speak to, we need to understand the future plan and then we
Yeah.
can
Yeah.
advise them
Okay. Yeah.
accordingly.
No.
And vice versa, if let's just say someone in the UK is thinking about moving over, we could speak to them 6 months in advance and say, look, plan it like this if you are looking to buy, and we can advise them on how to structure it.
Yeah. Okay. And then on credit, let's say in the UK,
Yeah.
so say they've got poor credit or they can't get a mortgage in the UK for whatever reason.
Yeah.
I'm not sure. Maybe they've got the money in a company or just can't get a mortgage in the UK.
Yeah.
How easy is it to obtain a mortgage here?
So if that person isn't living here, so they're non-resident, they live in the UK, the banks here, they don't. Some do ask for a credit report, but some don't.
Okay.
So it doesn't necessarily matter too much if there is a missed payment in the UK,
Okay.
for example.
So the ones who don't, it's you could have literally 5
Yeah.
black marks or whatever red marks on your
Yeah.
credit file, and they'll never ask it, never gets.
They don't need it. They don't ask.
So but they just have to prove where the funds are from and they're legit.
Yes.
Yeah. And like, even if they're in the savings account, how long did you have to be in there for like a certain like time, like 6 months, a year, or 3
It's normally
years?
6 months that
Okay.
they'll look back. So as long as you have X amount in savings, and
Yeah.
that X amount will be based on what what the mortgage payments will be on the mortgage. Because the banks will say, we need to see 6 months saved worth of mortgage payments. The reason they do that is because as a non-resident, they're assuming you will rent the property out.
Got you. Yeah.
So
Yeah.
essentially,
Yeah.
the savings are like the provision if you didn't have a tenant for the next 2 months, you could still pay the mortgage.
Got you.
And
Yeah.
because the banks are so confident in the rental market,
Mm-hmm.
they know that you'll rent it and the rent will cover the mortgage, which is why they underwrite it in that way.
And like in the UK, they have different fees, different rates for buy-to-let mortgages and
Yeah.
standard mortgages.
Yeah.
Here, is it just one rate for all, or is
Yeah.
it different?
So here, that concept of residential buy-to-let doesn't exist. It's just they don't care whether you live in it or you rent it.
Okay.
Because everything is underwritten based on your income,
Mm.
which sometimes is a good thing and sometimes is a bad thing.
Yeah.
Because in the UK, you can take a buy-to-let mortgage and the bank just looks at the rental income.
Yeah.
Whereas here, we're a little bit behind in the times.
Yeah.
I'm sure that
Yeah.
will come,
Yeah.
but it's a bit trickier to do it like that.
Okay.
So the norm is underwriting based on your income.
And so then rental incomes comes back to your bank here, but you'd still have to pay the tax because you're earning in the UK. You'd have to pay the tax on your rental income profit, I presume.
This is something a tax advisor will
That's
need to
perhaps. So yeah.
Sorry, it's out of my advisory skills.
So yeah, I think if they're working living in the UK,
Yeah.
they do have to pay the UK tax. They can't just like store it here and not avoid the
should call your
tax. About buy-to-lets. Oh, equity release.
Yes.
Yeah, equity release. So in England, what is it? Is it 25? How much can you borrow in England equity release? Do you have to just leave the deposit amount in the property, or
Exactly.
and down to what you can afford, to what you can pull out?
So as an example, let's say you live in the UK, you have your house, and normally you can pull out, if you live there, up to about 85% mortgage. It's a bit tougher the higher up you go in terms of the equity. But let's just say, broadly speaking, 85%. And then that money you can use to bring over here and invest in a property here.
Yeah, okay.
Whether that's off plan or ready unit, And then if you need to, then we can do a mortgage here
Yeah.
if you're buying a secondary unit.
And you do both in the UK and here mortgages, or just
Exactly.
here? Yeah.
Both. Cover both.
So it's a seamless
Seamless.
service. Equity release in Dubai.
Yes.
What's that looking like?
So it's a little bit trickier here in the sense that it's called controlled funds, which means that we can do the equity release for one of two reasons. One reason can be to do an equity release and then purchase another property, whether that's secondary unit or an off-plan purchase. So we'd need an MOU or an SPA. So that's one. The second route is for home renovations. In order to do that, we would need a building quote from a contractor, and that money that you're equity releasing for the home renovations will get paid into the contractor's account.
Directly?
Directly. So the money never goes into the client's account.
So that can be, especially with the contractors here, that could be very risky.
Yeah,
like,
you need to have a good contractor.
It could just, yeah. But could you speak to the bank and say, okay, well, we need 50% now, and then once the work's being completed, withdraw the next 50%, or do you have to take it all in a lump sum?
Yeah, you have to take it all in a lump sum. Either take it all in a lump sum now,
Yeah.
or you'd have to reapply in 6 months' time or a year's time.
And you can get a pre-approval to prove to the contractor you can afford this.
Yeah.
And how long would that sort of last, that pre-approval?
So the pre-approvals last for usually 60 days.
Okay.
So, and then you can redo it if you need to again.
Okay, so maybe after the can you do two? So say like you needed 50% now of the contractor's work. So you take that out, you pay the contractor, and then after it's taken like a year to do all the work or 6 months to do the work, so it's a big renovation. Like, can you apply again for a secondary one?
You can, yeah, you can then, exactly. So you can then apply again to then release however much you then need for the second part of the renovation.
And would that first one, that first product you get there, would that get cancelled and it'll just all be lumped into the second one? Or would it be?
Depends. It depends whether you stay with the same bank or whether we move you away from that bank. Because if we're talking a year later, I mean, the interest rates might have changed, criteria might have changed from the bank's point of view. So it might be better to just shift the finance to a different bank altogether and just take the whole lump sum.
So another thing I found quite interesting in Dubai is where in England, if you've got a 2-year fixed product, you have to pay normally 2% in the first year or 1% in the second year to get out. Where here it's capped at, I think, 10,000 dirham.
Yeah, correct.
Is that right?
Yeah.
Okay.
So it's 1%. It's either 1% of the remaining loan amount, but it's capped.
But capped at the 10,000.
Exactly.
Yeah,
so that's like £2,000 that you'd ever have to pay.
Yeah. That's the good.
So it's quite minimal.
So even if the rates do go down quite a lot and you're stuck into a product, you can just quite easily swap and turn.
Exactly.
Yeah.
And a lot of the banks, actually, if you are switching to a new bank, they will cover that fee.
Okay.
Yeah. So they'll do a cashback incentive because they want you as a client.
Yeah. Will the current bank, if they obviously know what you're doing, can you just show them this is my new rate at that bank, I'm going to do this? Would they try and claim the business back?
They could potentially. Here, because the market is not as regulated, shall we say, as it is in the UK, it's quite, there's no like, this is the process and this is what we will offer. It's more, you have to negotiate.
Okay.
But think of it, I always think of this analogy. Let's say you've got Sky broadband, right? And it's up for renewal, and they offer you X amount. Actually, they're offering more than Virgin, as an example. And even if you go to Sky and say, "Hey, Virgin are giving me this," they're like, "Well, we can't beat it, sorry." And then you end up going to Virgin, but you still try and negotiate
get it
with
down.
Sky.
Yeah.
So it's the same concept.
So they are flexible with rates, prices, or terms, sort of thing.
Yeah, I think it depends on you as a client, how much the mortgage is, how desperate they are for business at the time, depending on how much flex they have.
And then for second properties here, it's 40% down payment, isn't it?
Yes. Yeah. So this is something a lot of people don't know, is that there's a rule that you cannot have more than one mortgage above 60%.
Yeah.
So you could have 10 at 60% finance and then 1 at 80%.
Okay.
So you can still finance them, but the max would be 60%. As long as you can afford it all.
Yeah.
Yeah.
And the rates you can, so I think in the UK, it's about 4 times your annual salary you can borrow. Maybe 4 and a bit, or is it 4 less?
4 to 5.5.
Okay, yeah.
It depends on, yeah.
And then what would it be here on the amount you can borrow on your salary?
So it's about 7 times your income,
Okay.
roughly speaking.
And it doesn't matter if you're getting a rented product,
Yes.
the secondary home rented.
Yeah.
I suppose that just comes in as the income then and adds on to what you can borrow.
Because it's all underwritten on your earned income, as long as that can cover whatever you need, then the bank's fine. And the other rule that's good for people to know, because again, people aren't aware, is that there is a rule that you cannot have more than 50% of your salary as debt, whether that's mortgage, car loan, credit cards, personal loan.
Okay, so 50% of your salary is debt.
Can't exceed that.
Got you. Okay. And then what's the benefits to coming to you rather than just going directly to a bank to take the finance out?
So here in the UAE, a lot of clients do go to the bank direct because they think this is the best option. It's just easier. And let me tell you, it's not. So first of all, when you go to your bank directly, they can only offer you what they have. They can't. They're not going to say to you, "Hey, why don't you go and speak to Emirates MBD down the road because they'll have a better rate." And essentially, my job is to find you as a client, the best product, whether that's with Emirates MBD, FAB, ADIB, because we work with all the banks, and also from a service point of view, look after that client from start to finish. The bank is only involved in getting the client pre-approved and doing the mortgage application. That's it. They don't then, advise you on the contracts or advise you on the next steps. They don't create WhatsApp group chats with you. They're not connected in the whole process. It's very much, here's your pre-approval, here's your application, see you later. So for someone that wants that, go direct to the bank. But for those clients that want that service and want that hand-holding, should we say, and that advice, we're the people for you.
And you'd have a bit more pull on the documents and take a view and have a chat with the banks and different banks, see what they can do.
I would usually, when a client comes to me, we'd assess their situation, I'd advise them, we'd know which documents we need, and we take care of everything. So there's no headache for them to have to deal with the bank directly.
It's a bit like a real estate broker, going, instead of working to, let's say, Ellington or Emaar, you've just got the umbrella of different developers you can go to and find the best product.
Exactly.
So the rates in the UK, if you go to a financial advisor, sometimes can differ slightly, only marginally, but slightly, then going direct to the bank. To go here, is that the same? If you go to the bank, is it exactly the same rate?
Exactly the same. There's the rates are the rates. There's no differentiation in terms of if you went to Emirates MBD direct versus if I went to them on your behalf, it's the same interest rate.
Okay. And what's the sort of term of a mortgage you get out? Is it like England up to 30 years or 25 years, 20? How does it work?
So here, the maximum mortgage term is 25 years. And usually the maximum age is 65. But there are a few banks that go to age 70.
Okay.
But the term will always be 25 years.
So, for example, if you're 40, that's your sort of top limit of getting a 25-year loan.
And all of the mortgages here are on a capital repayment basis.
So there's no interest only?
There's no interest only.
Okay.
I do get asked about commission and bonuses. So, for example, the banks here, they don't seem to like the word bonus. Don't ask me why. But if you're getting commission, whether that's monthly, quarterly, annually, as long as it says commission, the bank will take it. They'll do an average, of course, of whatever period we're looking at. And usually they'll take 50% of that average.
Okay. So say you get say it's a commission-based job and the salary is minimal, and then you're bringing in 50,000 dirham, 100,000, let's say 50,000 dirham per month.
Yeah.
So would that be, so what could you sort of borrow on that? So they'll just average out over the year?
Yeah, so let's just say you're making 25,000 in commission every month.
Yeah.
And it's 25,000 average. Then the bank would take 12,500 as income. because they're taking 50%.
Okay. So you can never borrow as much as you get.
No.
They're not like
Because The reason is because it's variable,
Mhm.
technically. The banks obviously need to protect themselves and not over leverage.
Yeah.
So that's why they do the 50% haircut, essentially.
Got you. That's a
Yeah.
bit harsh. Yeah. And then, so if it comes in as a bonus, is that the same?
Banks don't like the word bonus.
Okay.
There are a couple of banks that will take a bonus, but
Mhm.
we do need to see 2 or 3 years track record of that bonus being received.
And of the similar amounts.
Say 50% haircut
Okay.
will be taken, so they'll do an average
Yeah.
again. Unless
Okay.
the latest year is lower,
Mm-hmm.
then they'll work off the latest year, which is the
The lowest.
lowest.
So I'm here with Victoria from SPF Private Clients, who's